Hello and welcome friends. Today we are going to discuss about the concept of standard costing and marginal costing, which is an important aspect to be considered by an entrepreneur in order to plan and control the various types of cost and for the optimum utilization of resources from an entrepreneur's point of view. What a product should have costed is more important than what it did cost. Entrepreneurs are constantly comparing their product cost with what it should have costed. Reasons for deviations need to be analyzed and remedial actions are taken. What a product should have costed is a question of great concern to an entrepreneur for improvement of cost performance. A scientific answer to this problem, that is, an answer based on reasons and consequences, is developed by use of standard costing and marginal costing, which is the subject matter of this program. I am Sakshi Mandwal and the subject expert of this program is Dr. Naseeb Ahmed, Honorary Deputy Director, Center for Innovation and Entrepreneurship and Associate Professor, Department of Commerce and Business Studies, Jamia Millia Islamia, New Delhi. He is having experience of about 17 years as a teacher and researcher in the area of entrepreneurship and finance. First of all, let's talk about standard costing and briefly discuss different terms to be used in this lesson. Standard. Standard is a desired attainable objective, a performance, a goal, a model. Standard cost. Standard cost is a predetermined estimate of cost to manufacture a single unit or a number of units during a future period. The Chartered Institute of Management Accountants, CIMA, London, defines standard cost as a predetermined cost which is calculated from management standards of efficient operation and the relevant necessary expenditure. It may be used as a basis for price fixing and for cost control through variance analysis. Standard costing. According to the Chartered Institute of Management Accountants, London, standard costing is the preparation and use of standard cost, their comparison with actual costs, and the analysis of variances to their causes and points of incidence. The study of standard cost comprises of A. Ascertainment and use of standard costs, B. Comparison of actual costs with standard costs and measuring the variances, C. Controlling costs by the variance analysis, and D. Reporting to management for taking proper action to maximize the efficiency. The various objectives of standard costing technique are to provide a formal basis for assessing performance and efficiency, to control costs by establishing standards and analyzing of variances, to enable the principle of management by exception to be practiced at the operational level, to assist in setting budgets, assigning cost to materials, work in process and finished goods inventories, forms basis for establishing bids and contracts and for fixing selling prices. To achieve the above objectives, the following steps are adopted in standard costing. Determining the standard for direct material, direct labor and different overheads. Ascertaining the actual cost of production. Ascertaining the variances by comparing actual costs with standard costs. Analyze the variances to know the reason for variances. Adopting corrective measures to control the variances in future. Advantages of standard costing. A good standard costing system results in the following advantages. Use of standard costing leads to optimum utilization of men, material and resource. Budgets are compiled from standards. Its use provides a yardstick for comparison of actual cost performance. Areas of strengths and weakness are highlighted. It acts as a form of feed-forward control that allows an organization to plan the manufacturing inputs required for different levels of output. It operates via the management by exception principle, where only those variances, that is, differences between actual and expected results, which are outside certain tolerance limits, are investigated, thereby saving managerial time. It motivates workers to strive for accomplishment of defined targets. It is very useful to management in discharging functions like planning, control and decision making, and price fixation. It creates an atmosphere of cost consciousness. Its introduction leads to simplification of procedures and standardization of products. However, there are some disadvantages. Limitations of standard costing, such as a lot of input data is required, which can be expensive. Unless standards are accurately set, at any performance evaluation will be meaningless. Uncertainty in standard costing can be caused by inflation, technological change, economic and political factors, etc. Standards therefore need to be continually updated and revised. The maintenance of the cost database is expensive. Setting of standards involves forecasting and subjective judgments with inherent possibilities of error and ambiguity. Standard costing cannot be adopted in the firms which do not have uniform and standard production program. It is very difficult to predict controllable and uncontrollable variances. Now let's discuss the applications of standard costing as a controlling technique. It is essential for management to have knowledge of costs so that decision can be effective. Management can control costs on information being provided to it. The technique of standard costing is used for building a proper budgeting and feedback system. The uses of standard costing to management are as follows. Formulation of price and production policies. Standard costing acts as a valuable guide to management in the fixation of price and formulation production policies. It also assists management in the field of inventory pricing, product pricing, profit planning, and also in reporting to top management. Comparison and analysis of data. Standard costing provides a stable basis for comparison of actual with standard costs. It brings out the impact of external factors and internal causes on the cost and performance of the concern. Thus, it helps to take remedial action. Cost consciousness. An atmosphere of cost consciousness is created among the staff. Standard costing also provides incentive to workers for efficient performance, better capacity to anticipate. An effective budget can be formulated for the future by laying price knowledge of the deviations of actual costs from standard costs. Data are available at an early stage and the capacity to anticipate about changing conditions is developed. Better economy, efficiency and productivity. Men, machines and materials are more effectively utilized and thus benefits of economies can be reaped in business together with increased productivity. Delegation of authority and responsibility. The net profit is analyzed and responsibility can be placed on the person in charge for any variations from the standards. It discloses adverse variations and particular cost center can be held accountable. Thus, delegation of authority can be made by management to control the affairs in different departments. Management by exception. The principle of management by exception can be applied in the business. This helps the management in concentrating its attention on cases which are off standard, that is below or above the standard set. A pattern is provided for the elimination of undesirable factors causing damage to the business. Setting the standard. While setting standard costs for operations, process or products, the entrepreneurs should take into consideration the following. Establish standard committee comprising purchase manager, personnel manager and production manager. The cost accountant coordinates the functions. Study the existing costing system, cost records and forms in use. A technical survey of the existing methods of production should be undertaken. Determine the type of standard to be used. Fix standard for each element of cost. Determine standard costs of each product. Fix the responsibility for setting standards. Account variances properly. Ascertain the deviations by comparing the actual with standards. Take necessary action to ensure that adverse variances are not repeated. Determination of standard costs. The following preliminary steps are considered before setting standards. A. Establishment of cost center. B. Classification and codification of accounts. C. Types of standards. And D. Setting the standards. Let me explain these further. A. Establishment of cost center. For fixing responsibility and defining the lines of authority, cost center is necessary. A cost center is a location, person or item of equipment for which costs may be ascertained and used of the purpose of cost control. With the help of cost center, the standards are prepared and the variances are analyzed. B. Classification and codification of accounts. Accounts are classified according to different items of expenses under suitable heading. Each heading may be given codes and symbols. Coding is useful for speedy collection and analysis. C. Types of standards. The different types of standards are: basic standard. It is fixed and unaltered for an indefinite period for forward planning. From this basic standard, changes in current standard and actual standard can be measured. Current standard. It is a short-term standard as it is revised at regular intervals. It is established for use over a short period of time and is related to current conditions. Normal standard. It is an average standard and is based on normal conditions which prevail over a long period of a trade cycle. It is used for planning and decision making during the period of trade cycle to which it is related. Ideal standard. The standard which can be attained under the most favorable condition possible. It is fixed and needs a high degree of efficiency, best possible conditions of management and performance. Expected standard. It is a practical standard defined as the standard which it is anticipated can be attained during a future specified budget period. For setting the standard, due weightage is given for all the expected conditions. It is more realistic than the ideal standard. Setting the standards. After choosing the standard, the setting of standard is the work of the standard committee. Standards cost is determined for each element of the following costs. Direct material cost. Standard material cost is equal to the standard quantity multiplied by the standard price. The setting of standard cost for direct materials involves: A. Standard material quantity. For each product or part or the process, mechanical calculation or mechanical analysis is made. The allowance for normal wastage or loss must be fixed very carefully. Similarly, where different kinds of materials are used as a mix for a process, a standard material is determined to produce the desired quality product. B. Standard material price. Setting of material standard price is done by the cost accountant and the purchase manager. The current standard is the desirable and effective for fixing the price. Normally, 1 year is the period for fixation of standard price. If there are more fluctuations in prices, then revision of standard price is necessary. Second, setting standard for direct labor. The standard labor cost is equal to the standard time for each operation multiplied by the standard wage rate. Setting of standard cost of direct labor involves: A. Fixation of standard time, and B. Fixation of standard rate. Fixation of standard time. Standard time is fixed by time or motion study or past records or test runs or estimates. Labor time is fixed by the work study engineer. While fixing standard time, normal ideal time is allowed for fatigue, normal delays or other contingencies. Fixation of standard rate. With the help of the personal manager, the accountant determines the standard rate. Fixation of standard rate is influenced by union's policy, demand for labor, policy to be followed, and method of wage payment. Third, setting standard for overhead. Overheads are divided into fixed, variable and semi-variable. Standard overhead rate is determined on the basis of past records and future trend of prices. It is calculated for a unit or for an hour. Standard variable overhead rate is equal to standard variable overhead for the budget period divided by budgeted production units or budgeted hours for the budgeted period. Standard fixed overhead rate is equal to standard overheads for the budget period divided by budgeted production units or budgeted hours for the budgeted period. Revision of standards. Standards have to be revised from time to time, taking into consideration changing circumstances. The circumstances may change on account of technical innovations, changed market conditions, increase or decrease in plant capacity, developing new products, or giving up unprofitable production lines. If variations from actual occur in practice, they may be due to controllable or uncontrollable causes. Standards should be revised only on account of those causes which are beyond the control of the management. Changes in production design, supply of labor and material, changes in market conditions for a long period, trade or cyclical variations would impel the management to revise the standards. The objective, while comparing the actual performance with the standard performance and revising standards, is to facilitate better control over costs and improve the overall working and profitability of the organization. Apart from the above, basic standards are revised in the course of time under the following circumstances: when there are permanent changes in the method of production, designs and specifications, plant capacity has changed, there is a large variation between the standard and the actual. Marginal costing. Now let's discuss the other technique, that is marginal costing. By analyzing the behavior of costs in relation to changes in volume of output, it becomes evident that there are some items of cost which tend to vary directly with the volume of output. The costs that vary with volume of output are called variable costs, and those remain unaffected by change in volume of output are fixed cost or period costs. Marginal costing is a study where the effect on profit of changes in the volume and type of output is analyzed. The cost of one additional unit of output is known as marginal cost. In other words, it refers to the cost that is incurred by a business to move from output level N to N plus 1. Thus, marginal cost is the cost incurred by a business for the additional output. Marginal costing. Marginal costing is an accounting technique which ascertains marginal cost of additional output by differentiating between fixed and variable costs. This technique aims to charge only those costs to the cost of additional product that vary directly with sales volumes. Those costs would be direct material, direct labor and factory overhead expenses like supplies and some indirect labor and power. The cost of the additional product would not include fixed or non-variable expenses such as depreciation, factory insurance, taxes and supervisory salaries. Thus, marginal costing is a costing technique that considers only the costs that vary directly with volume, direct materials, direct labor and variable factory overheads, and ignores fixed cost and additional output decisions. The technique of marginal costing lies in differentiation between fixed and variable costs, ascertainment of marginal costs, and finding out effect on profit due to change in volume or type of output. Marginal costing, being a technique, can be used in combination with other techniques such as budgeting and standard costing. It is helpful in determining the profitability of products, departments, processes, and cost centers. Let's see some definitions. According to the Institute of Cost and Management Accountants, London, marginal costing is the ascertainment by differentiating between fixed costs and variable costs of marginal cost and of the effect of profit of changes in the volume or type of output. Batty defined marginal costing as a technique of cost accounting which pays special attention to the behavior of costs with changes in the volume of output. Kohler's Dictionary for Accounting defines marginal costing as the ascertainment of marginal or variable cost to an activity department or products as compared with absorption costing or direct costing. Features of marginal costing. The following are the special features of marginal costing. Marginal costing is a technique of working of costing which is used in conjunction with other methods of costing. Fixed and variable costs are kept separate at every stage. Semi-variable costs are also separated into fixed and variable. As fixed costs are period costs, they are excluded from product cost or cost of production or cost of sales. Only variable costs are considered as the cost of the product. As fixed cost is period cost, they are charged to profit and loss account during the period in which they are incurred. They are not carried forward to the next year's income. Marginal income or marginal contribution is known as the income or profit. The difference between the contribution and fixed costs is the net profit or loss. Fixed costs remains constant irrespective of the level of activity. Sales prices and variable costs per unit remains the same. Cost volume profit relationship is fully employed to reveal the state of profitability at various levels of activity. Assumptions in marginal costing. The technique of marginal costing is based on the following assumptions. All elements of costs can be divided into fixed and variable. The selling price per unit remains unchanged at all levels of activity. Variable cost per unit remains constant irrespective of level of output and fluctuates directly in proportion to changes in the volume of output. Fixed cost remains unchanged or constant for the entire volume of production. Volume of product is the only factor which influences the cost. Advantages of marginal costing. Marginal costing is an important technique of decision making. It is a tool for cost control and profit planning. The following are the advantages and applications of marginal costing for an entrepreneur. Profit planning. There are 4 important ways of improving the profit performance of a business: increasing the volume, increasing the selling price, decreasing variable cost, and decreasing fixed costs. Profit planning is the planning of future operations so as to attain maximum profit. The contribution ratio shows the relative profitability of various sectors of business whenever there is a change in the selling price, variable cost, etc. Introduction of a new product. Sometimes a product may be added to the existing line of products with the view to utilize idle facilities to capture a new market or for any other purpose. The profitability of this new product has to be found out initially. Usually, the new product will be manufactured if it is capable of contributing something towards fixed costs and profit after meeting its variable cost. Level of activity planning. Marginal costing is of great help while planning the level of activity. Maximum contribution at a particular level of activity will show the position of maximum profitability. Key factor. A concern would procure and sell only those products which offer maximum profit. This is based on the assumption that it is possible to produce any quantity without any difficulty and sell likewise. However, in actual practice, this seems to be unrealistic as several constraints come in the way of manufacturing as well as selling. Such constraints that come in the way of management's efforts to produce and sell in unlimited quantities are called key factors or limiting factors. The limiting factors may be materials, labor, plant capacity, or demand. Entrepreneurs must ascertain the extent of the influence of the key factor for ensuring maximization of profit. Normally, when contribution and key factors are known, the relative profitability of different products or processes can be measured with the help of the following formula. Profitability is equal to contribution divided by key factor. Make or buy decisions. A company might be having unused capacity which may be utilized for making component parts or similar items instead of buying them from the market. In arriving at such a make or buy decision, the cost of manufacturing component parts should be compared with price quoted in the market. If the variable costs are lower than the purchase price, the component parts should be manufactured in the factory itself. Fixed costs are excluded on the assumption that they have been already incurred and the manufacturing of components involves only variable cost. Suitable product mix or sales mix. Normally, a business concern will select the product mix which gives the maximum profit. Product mix is the ratio in which various products are produced and sold. The marginal costing techniques helps management in taking appropriate decisions regarding the product mix, that is, in changing the ratio of product mix so as to maximize profits. The technique not only helps in dropping unprofitable products from the mix, but also helps in dropping unprofitable departments, activities, etc. Pricing decisions. Marginal costing techniques help a firm to decide about the prices of various products in a very easy manner. Accepting a bulk or foreign order. Marginal costing technique can also be used to take a decision as to whether to accept a bulk or foreign offer or not. The speciality of this situation is that normally bulk or foreign order is requiring the manufacturer to supply the product at a price lower than the usual selling price. Here the decision is taken by comparing the marginal cost of the product with the foreign price offered. If the foreign order offers a price higher than the marginal cost, then the offer can be accepted subject to availability of sufficient installed production capacity. Limitations of marginal costing. Marginal costing has the following limitations. 1. Difficulty in classification. In marginal costing, costs are segregated into fixed and variable. In actual practice, this classification scheme proves to be superfluous in that certain costs may be partly fixed and partly variable, and certain other costs may have no relation to volume of output or even with the time. In short, the categorization of costs into fixed and variable elements is a difficult and tedious job. Second, difficulty in application. The marginal costing technique cannot be applied in industries where large stocks in the form of work in progress, job and contracting firms are maintained. Third, defective inventory valuation. Under marginal costing, fixed costs are not included in the value of finished goods and work in progress. As fixed costs are also incurred, these should form part of the cost of the product. By eliminating fixed costs from finished stock and work in progress, marginal costing techniques present stocks at less than their true value. Wrong basis for pricing. In marginal costing, sales price are arrived at on the basis of contribution alone. This is an objectionable practice. For example, in the long run, the selling price should not be fixed on the basis of contribution alone, as it may result in losses or low profits. Other important factors such as fixed costs, capital employed should also be taken into account while fixing selling prices. Further, it is also not correct to lay more stress on selling function as is done in the marginal costing and relegate production function to the background. Limited scope. The utility of marginal costing is limited to short-run profit planning and decision making. For decisions of far-reaching importance, one is interested in special purpose cost rather than variable cost. Important decisions on several occasions depend on non-cost considerations also, which are thoroughly discounted in marginal costing. In view of these limitations, marginal costing needs to be applied with necessary care and caution. Fruitful results will emerge only when management tries to apply the technique in combination with other useful techniques such as budgetary control and standard costing. We shall discuss the practical applications of marginal costing in the chapter on break-even analysis. I hope you are now able to understand the concept of standard costing and marginal costing. That is all that we had for you in this episode. Till the next time, it's a goodbye.
Thank you.